Welcome back to the Getting Past the Premium podcast, everybody. Thanks for joining us again. Today we've got a pretty exciting episode with Ben Woods, who is a Stewardship Advisor for Ellerbrock-Norris Wealth Strategies. And Ben's going to give us a pretty interesting perspective on his involvement in the financial services industry and seeing that transition from a transactional model to an advisory model on that side of the industry. So we're really looking forward to this conversation and hope you enjoy.
Welcome to the Getting Past the Premium podcast.
All right, welcome, man.
Hey, man. Thanks for having me out.
How's it going, Ben?
Yeah, nice to see you
This
guys.
makes 2 episodes in a row that the guest has brought the drink.
As they should.
I like it.
I mean, you guys
I
do
like
all the
this
work.
trend.
We just have to sit down and have a little conversation. So,
There we
you know,
go.
you deserve
What are we
it.
drinking?
Oh, this is out of a local group. Everybody knows it, Kros strain.
Everybody probably in Omaha knows it. Now.
Yeah,
Our
not
French,
naturally.
Our French listeners, maybe
Yes.
not. But
Do we have any more international
We
subscribers
got
besides
some from
France?
Germany.
Germany.
now, huh?
That's
We
right.
got like Minnesota, Wisconsin. It's starting to spread. So
Well, if you need a beer to order, Kros Strain Brewing Company out of Omaha, Nebraska.
Fantastic.
This is the
good.
Juice and Desist double IPA. It's delicious.
Looks like
is
orange
great.
juice.
That's right, it does. For those of you watching.
Yep.
So we want to kind of get your perspective, you know, being on the financial services side of the industry. Last episode, we talked about kind of the property casualty insurance side, but you have an interesting perspective being in the industry that went from kind of that transactional model to an advisory model, right?
Yep.
And so we just kind of want to get your perspective on, you know, how did that transition happen? What did you experience over the years? And
Sure.
how does that now bring value to your clients and how you operate today? So maybe start out, just give a brief kind of overview of your perspective in the industry over the years, and we'll go from there.
Well, I got started back in the 90s. 96 is when I kind of rubbed up against the industry, and it was with a buddy of mine who was in like a full service type brokerage situation, and I did a little interning with him. Found out I didn't like calling people that didn't know who I was, just cold calling folks. I did not like that. So I ended up hooking myself up with a firm. I don't know if we should really throw firm names out.
That's all right.
Kind of rhymes with Schwab.
Yeah, we're okay. We can throw out any names we want.
So I started working with those guys, and they were more in what we would call the discount brokerage type of world.
Yeah.
But to create revenue, they were very transactional in how they did things. Clients initially came to them just because they wanted to kind of self-direct their assets, but the more folks understand that there's a lot that goes into this, they start wanting guidance and some help. And so, they took it upon themselves to, put together some guidance that was very product driven, charging some, fees for that management. And then sometimes just, buying, like a one-time type of advisory product. And so we worked in that model for a while, and then they kind of saw that there were multiple layers that were not being addressed by the industry, whether that was in insurance, estate planning, other facets that touch those clients, their 401k plans, because quite frankly, the average person has a lot of things going on. And as we, move throughout our life, we open up a 401k at this place and have an IRA over there, and it gets scattered.
Oh, yeah.
And so the big thing was trying to pull those things together. And that particular firm was at the cutting edge of that. And that's where I learned a lot of my training is with Schwab. I was one of the first people to start their private client organization, and learned a lot from those clients as we transitioned from not just looking at them as a unit to make revenue on and make money on, but also as a whole person, and to try to really understand, how we can help them in multiple facets of their financial situation. That became very helpful because then the clients typically would stay with us longer.
Stickiness, absolutely.
The stickiness of it, for sure.
Yeah, you mentioned a couple things in there, not to jump in, but I think that I think it's important to highlight is people's situations are complex. My advisor's sitting to my left, and I still don't know what the hell is going on in my situation. But we'll get it figured out. But no, I think you said something in there which I do want to equate to just the insurance and risk management industry as a whole. There, and I want to make sure I got this right, that kind of that first part of the transitionary model was advisory, but are still around a product. Is that
absolutely?
Because I think that is where, and you might have some perspective on this, where the insurance and risk management industry sits a little bit today. It's like this first part of that, we kind of want to be advisors, but we're still very product driven, right? And so
I feel like we're sitting, 100%. I mean, I feel like we're sitting, tell me if I'm wrong, Ben, in the late 90s in the risk management space when we're looking at, the financial services industry, where it was commission driven, trade ticket commission driven. So people would call up their stockbroker and say, hey, I want to trade however many shares of XYZ, and they'd get paid a fat commission for that, depending on,
what they're trading. And
exactly. And volume, all the things that go into calculating that. And they made a heyday. They were printing money. And but some things happened in the financial services industry that haven't happened in the insurance industry that has really changed the game, in my opinion. And we could chat about this, Ben, but like 01, 02, people were trading tech stocks like crazy back in the late 90s, and then the bottom fell out of the market, and it was a catalyst for change.
Pain brings change.
Yeah.
Right. I mean, and I think couldn't agree more with that, right? I mean, at that point, people didn't know what they had. They didn't know the risk that they were taking on. So like I was saying, you would have your assets spread between 4 or 5 different brokers, but they were all buying the same stuff. They may have had mutual funds with Janus and Fidelity and whatnot, but it was all invested in similar areas of the market. Because those mutual fund managers, they don't chat about Bob's particular situation. They just invest their funds based on whatever their directives are. And so many of them were running with 50, 60% in technology at that time. So when the bottom fell out, folks lost way more than the overall market did. I mean, I saw people lost 60, 70, 80% during that 3-year span of that bear market. Little known fact, if you would have been a little bit more globally invested and invested in other areas besides technology and large companies, you would have lost way less. We're talking to the tune of maybe 25, 30, depending on how much you had in those different areas. So I think the industry as a whole and the consumer is the one that helped drive that change.
Yeah. So would it be fair thinking about that pain when you say that, 50, 60% of some of those people's portfolios were in certain products, mutual funds or whatever it is, would that be because it was the product-driven model and not somebody looking, as you mentioned in the latter half of what you were saying, that they weren't taking this advisory perspective of looking at the client situation as a whole and saying, what is best for this client? It was from the product perspective. Is that accurate?
That's accurate. I mean, that is accurate. I mean, it for the most part, there wasn't nearly as many independent, holistic type of, planners out there in the industry back then. That's fairly new in the last 15 years.
So maybe describe what you mean by that, by the independent, looking at the entire picture.
Yeah, so a good independent registered investment advisor, somebody that's going to act on behalf of the client, put the client's interests in front of their own and their firms, that's where you want to be. And that's where the model is going towards actually getting on the right side of the client. Whereas in the past, a broker-driven model, they had to just show that what they gave in terms of advice was suitable.
Yeah.
Right? And that's it. Nothing more than that. And so I have an analogy that I typically say to just kind of break it down. It's like if I was having some health issues and my health was kind of fading and I wasn't sure what was going on and was eating or what have you, I wouldn't go to a butcher to get that information. I'd go to a nutritionist, because the nutritionist is going to sit back. He's going to take a good accounting of all the things I'm putting into my body and the way I'm doing it. He's going to take a blood test. He's going to spend a lot of time up front to truly understand everything that's coming inside me and possibly affected me.
Yeah.
Whereas a butcher, he's got really one thing to sell, and that's meat.
Yeah.
maybe some fish.
Got a damn
not
good
his fault.
He's got a damn good T-bone.
He's got a great T-bone, and we all love the good butcher.
What do you think, Ben? Like 3 T-bones a week? Is that a good diet?
I guess there is a carnourbore diet out there.
There
I've
is.
heard some things
Yeah.
about that.
Same
I've
guys
not
that are
tried it
putting butter in their coffee in the morning.
That's a different podcast.
True. Anyways, I didn't mean to interrupt your.
Yeah, that's a
Butcher.
great analogy,
It
though.
is.
You know, if you go talk to a butcher, you can't expect to get sold a salad.
No.
Yeah.
And,
You need a salad.
Or I'm not
Yeah.
sold, but recommended to go eat a salad.
Mhm.
Yeah.
Or maybe just go for a jog.
Yeah.
So, yeah,
Yeah.
that's a great analogy.
Yeah, the one-size-fits-all approach is what was there forever. But I do think consumers are the ones that kind of push the envelope in the end. Big businesses normally won't make changes unless the consumer's begging for it. And so now you see in my industry, everybody is a financial planner.
Yeah.
And everybody is using financial planning. Come get your free financial plan. Everyone's talking about being fiduciaries, right? So the language gets absolutely co-opted. And sometimes you're talking to somebody that you think has your best interest at heart, but they're actually still a broker.
Yeah.
And so a lot of the behaviors are, if your advisor is not asking for, your last couple of years in taxes, they're not asking to see all of your investments. They're not taking the time to ask the hard questions and to really understand what's important to you as a person and for your family, then you might be with the broker.
Yeah. Absolutely.
Because there may be a product. A lot of times they'll take you through a financial plan real quick, to say they covered that, but it's really just pointing to something they're selling.
Specific products are selling. Yeah. So I think that's an important. So take it maybe out of your experience in just the financial services and just think about how you approach a client from that advisory perspective, and just talk through that approach and then relate it to your experience as selling that product, or the advisory from a product. You're not necessarily talking specific mutual funds or whatever, but just the approach, because I think that can apply whether you're selling property casualty insurance, health insurance, financial services, anything, right?
Yeah, correct. I kind of call it's kind of reverse engineering. Is you're trying to get a good understanding of what wealth means to a person. Wealth means a lot of different things. Words mean a lot of different. Different words have different weight, but to me, wealth is simply an extension of what gets you the experiences that you want in your life. I think there's like a Thoreau quote that's like that, kind of, right?
Deep.
Yeah, but but each person, the way that they look at wealth and they look at what it does for them, they tackle it differently. And so, as a good advisor, you're really trying to, quite frankly, be very much a psychologist and try to understand what is important to them and what is the barriers that are in front of that person to getting what they want. And taking, really that really solid intake. So to go back to that one analogy about the nutritionist, I had that exact problem where my health kind of faded and I kept going to doctors and they kept prescribing me different things to try to fix it real quick. And then I found a naturopath and I went to him. My first time with him was an hour and a half intake. Good, solid conversation about everything in my past, my parents' past, everything else. And then we did blood tests. So we didn't even get to his recommendations until like the third meeting. To me, that's what it's all about. Yeah. It's not rushing to something at the end. It's to really understand that person fully and what makes them tick. That to me, that's what I love about what I'm doing now. I haven't been doing that in the past. It was very much the planning just to get to, okay, let's get this, whatever it is that we're trying to get to. We did a commission, yeah. Whereas now it's very much understanding that client and what is important to them and their legacy. And then we start working on all the different areas, figuring out, okay, what areas do we have covered? Where do we have gaps? That's huge. And then after you've done that, it doesn't end there.
Yeah.
Then it's the beautiful part about the relationship. Yeah, because the one thing about investing completely on your own is Warren Buffett's mentor, Ben Graham, said the investor's problem and his chief enemy is likely to be himself. And that's huge. I mean, I've heard people many times say to me, Ben, I don't want to have anybody manage my money. My money is more important to me than it is to them. Nobody's going to take care of my money. Yeah, right?
Absolutely.
And that's true, but that's also because the problem with that is that you're holding too tight. And so when we have little things that happen in markets and whatnot, we suddenly find out who has a strategy and who's just listening to ideas.
Yeah.
And they don't really have a true strategy that's rooted in anything. And a good advisor has that. They have a strategy that they can articulate and educate their clients so the clients are on the same page with them. And I can't stress that enough. A good advisor is an educator, and he's going to take the time
So well said.
to let that person understand.
And there's not an annuity at the end of the education.
Correct, sir.
What's the Dalbar study been? Doesn't it? I mean, that kind of puts numbers around exactly what you're talking about.
Yes.
The average investor dramatically underperforms the benchmark.
Absolutely. Yeah, Dalbar study was these geniuses out in Chicago. They do this every year, and they run it basically on a 20-year rolling, where they're looking at just the performance of the S&P 500 and compare that to the inflows and outflows and mutual funds and what the individual investor who's doing it on their own, how they're doing. And so the average is about 8.56 or so for the S&P 500, and the passive investor comes in at about 4.75, somewhere in there. I don't know the exact percentage, but it's in that realm.
Half.
It's half, and it's been that way for the last 40 plus years since Dalbar has been, running those studies.
So it hasn't been very consistent. Is what you're saying.
Well, and that really just pays the fact we are emotional people. We are created that way, and the fear and the greed is our worst enemy. And the folks that are on the TV channels and the news publications and stuff, they're not our friends either. They're also our enemies in a way, because they're there to just get us to watch their programming.
So they can sell advertisements, right?
Yeah.
It's so true.
And nothing gets you to watch like being scared or regretting, like, doggone it, I should have got into those cryptocurrencies or whatever, to the moon.
That's another podcast right there, yeah. So I liked something you said there around wealth, of just words mean something different to everybody. And again, equating that to the industry as a whole, risk.
Yes.
Risk means something different to everybody. We've had this discussion at length around risk management. That can mean something different to anybody at any point in time in their life or their business or whatever. And so knowing that means something different to everybody, how do you get to the bottom of defining that at the client level? Does that make sense?
Yeah.
Because every client's going to see it differently. So whether it's wealth or risk or just through your process, how are you going to understand what wealth means to the client or what's important to them?
So that's a great question, my friend.
Every once in a while.
In our industry, they tried to boil it down to a boilerplate risk questionnaire, right? Because we try to boil everything down to just these 5 questions. That'll get you, right? Yeah. And you can ask that questionnaire to somebody, and it depends on what the markets are doing at that time.
Oh.
To be quite frank, because you can take them through that risk questionnaire, and if markets are doing really, really well, they are at a 10. They can tolerate anything, any type of volatility.
They want to.
Yeah, they want to.
True, yeah.
But the key thing about volatility and understanding volatility is, we all love volatility when it's working in our favor. When it's working against us is that it's negative. We don't like that. And the brain actually, it hates losing money. It hates that. It hates it more than making money. The studies have shown that over and over again. So we are all very adverse to that downside. But if we haven't been there, we have this recency bias, right? So if in recent times, and this is what happened there for a while, we had over 10 years without a bear market. That's crazy. That's a long period that we went from 2008 to, through that last period, right? Longest bull market in history. People's recency bias, they forgot about what it felt in 08. So, a good advisor who has had time in the seat or had time working through multiple different ups and downs will be able to ask more pointed questions about how they actually felt when that happened and maybe recreate the situation for them. Not just a risk questionnaire, right? I'll be honest with you, those are the vein of my existence. You got to go through them, but I think the financial planning tells the story so much better in a risk questionnaire, because when you get to the end of it and you say, you know what, you don't have to take that much risk. Yeah. We've actually done a great job saving. We've got enough assets here that we don't have to do that. We can turn off the TV. We don't even have to have that much exposed to stocks. We can do it a different way. Yeah. And that's the educating part of it. But yeah, to your point, risk is one of the hardest ones to come down to, because like the pain part of it, you know?
So true. And
everybody perceives risk differently. Sometimes you don't know what you don't know.
Yeah.
That's the thing we always get into.
Depends on experience.
Yeah, depends on the experience.
And recent experience.
Yes.
Yeah, I don't know. It's, gosh, my brain is in a hazy double IPA right now. But
you need to juice and desist.
Right? Great beer, by the way.
Yeah,
but
excellent.
You know, I'm caught in the middle between these two sides of like the risk management industry and then the financial services industry, because, you know, you're right, Ben. In the financial services industry, people love risk when it's making them money.
Yeah.
You know, they're like, and it makes sense to them, right? We say things like, there's no free lunch, and the only way to make money is to take on risk, and da-da-da-da-da-da-da. Mm-hmm. Obviously, all that's calculated and way more complex, but that's the point. On the insurance side, though, you know, insurance carriers will run commercial after commercial about how, you know, one ding in the car from a basketball hoop falling on the trunk is going to cause financial ruin, and they should insure themselves for it.
Yeah.
Like,
yep.
You know, it gets me uber passionate about being that quarterback that sits in the middle of all of this, mm-hmm. that ties all the dots together, because there's so many things. You said the word earlier, psychology. There's so many things going on here that it's ridiculous. Mm-hmm. So, I don't know. It's an observation. It's super complex, but you're going to walk into an insurance broker's office and they're going to talk to you about how you might not want to lose $1,000, or, you know, what would you do if you were in that situation? Or it might only cost you $15 a year to transfer that risk to an insurance carrier who will take over the burden of that $1,000 risk. But in the stock market, it's like, let's keep pulling the jackpot lever.
Well, it's interesting you said it, because I think that the industry is stuck in the middle. I'd love just your perspective. If I think about the insurance and risk management industry right now as we just said, as where the financial services industry was, say 20 years ago, whatever. Yeah. Mm-hmm. And so I think it's incumbent upon everybody listening to this podcast, or those that want to figure out a better way to work with clients, to say either, number one, the day of reckoning is coming. Yes. It happened in the financial services industry. And if you were, I mean, I know there's still brokers that operate out there, but
sure,
it's a lot harder than it was. I feel like, I don't have a crystal ball, but that day is coming in the insurance. It just kind of makes sense. The commission model, the product sale model, when it comes to financial services products, risk management products, it naturally kind of takes that trend, or has. When you look at health insurance is getting that way, yeah. And eventually the property casualty side will. So I think your perspective on, you know, what you know, being at Ellerbrock-Norris, with where that's going as an industry. And then if I'm an advisor, we always love this question. If I'm an advisor who's a current, you know, P&C broker, mm-hmm. what can I do to take more of that advisory model to my clients, even though I might still be stuck in that industry that's very product focused?
Yeah.
You know,
it's a switch in thinking, because, you know, we all are driven a little bit by, you know, what, you know, we're working, right? This isn't a hobby.
Gotta put food on the table,
right?
Gotta buy more cross strain, you know?
Yeah, but in the end, I've always lived by a motto that, you know, you'll get everything you want out of life if you help other people get what they want, right? And so, you know,
now
when
that's a quote at Big Al.
I stole it, so but but it's a good one.
Props to whoever said it.
I think that's a Ziegler quote, if I'm not mistaken. But you know, in the end, going into those meetings with the client, and you look at them as like they're like the hero of the hero of their story. If you're a CEO or you're a really good business owner, and I'm saying a good one, they're not all good.
No, true.
Okay, but if you're a good one, then you care about your employees. You care about the people you're servicing, whatever industry that is. You do truly care about it. Mm-hmm. And a good agent becomes a thought partner to that person. That is their goal number one. They want to be a part of their story. They want to be not the director. Well, yeah, maybe the director. I mean, we're talking about a movie, you know, and they're in the movie, right? And you want to be the director of that movie for them. So you're sitting there when you're having your conversations, trying to really understand what they want in the next few years and understanding every facet that is important to them for their employees and the people they serve. And there's going to be a ton of opportunities in there. There's going to be a ton. Yeah. And in the end, both businesses are trust businesses. And the more you can show value in multiple different areas in a person's life, the more they will trust you. And I think that's really what we should all be seeking, is to get on the level with our clients that they know that we care, that we're not there just, for our own benefit. We all do real well, in our industries, right? Yeah. There's no reason why I can't all come together with our clients in a really neat way that really helps them with their bottom line.
Yeah.
Well, I think at the end of the day,
that's awesome.
Yeah, the revenue follows, from an advisor perspective.
Yes.
The revenue follows doing the right activity, and
if you can do that, you separate yourself from 90+% of the others that are doing it and are still stuck in that model. You absolutely do. And then what you end up doing is you create raving fans that will refer you business that is very similar to theirs. And then you start building a book of business that is fun to work with.
Yeah. So you've made this transition, right? Coming from the most transactional of transactional worlds to, now you sit in a boutique, highly custom shop, fiduciary only, doing the right thing for the client. Like, how you had to personally make mind shifts throughout that journey.
Definitely.
So I'm curious if there were defining moments in your life where you're like, shit, I might not have done the right thing. Was that the first cuss word on the podcast?
I'm not sure.
Is this family friendly?
We're not anymore.
I'm glad you're the first one.
Yeah. Well, now it's only for 7 and older. Okay.
It's just a passion coming through.
Yeah.
It's just a passion. Yeah.
So there were, defining life moments were there where you were like, dang it, there's got to be a better way for you to get to the point today where you're saying, this is the only way to do business, and that's it.
Yeah, without a doubt. So after 2008, I was managing, I had about $370 million under management that I built, along with the firm, Sydney business, blah, 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 whatever, and over 350 clients. That's a lot of clients. And so when all hell breaks loose, when my clients need me most, I can't get back to all of them. So I was working ridiculous amount of hours and having the same conversations. It was very difficult. I had no hand in my book. I wasn't able to build it the way I wanted to. I didn't get to spend the time educating clients so they wouldn't panic. So they would understand, like, when markets go down in one area, other markets go up. Mm-hmm. And we have you covered in other areas. We're going to sell from the areas that are actually up and doing pretty well, and we're going to buy into the areas that are not doing well, right? Because that's a beautiful opportunity. Those opportunities only come around every 3 to 5 years for bear markets, and once a year you get a 10% downturn. But a nicely crafted portfolio, there's always a market making money. Mm-hmm. But if a client doesn't know that because we didn't get to spend the time educating them, then it's just going to wear you out on the backside because you got 350 plus clients that are now calling you. And you do have many of them you do care about and you like, and many of them, but 350 you don't know them all. You don't care about all
perspective.
Yeah. And whereas we're building something extremely special where every client we bring in, it's It is a mutually, we bring them in. If it's a great fit, we bring them in. If it's not a great fit and somebody else can do it, we'll happily give them a referral to someplace else.
Yeah.
But in the end, we're trying to make sure that we're a good fit, they're a good fit, and that we can get them to where they want to be.
So it's more about the model.
I
guess is what you're
100%
saying.
more about the model. Yeah.
And it's interesting because, that's, if I can sum up what you've said, it's engage a client on a deeper level, be probably more holistic and broad in your advice, and in turn, probably your fee and revenue.
Yes.
Get to spend more time with that client.
Yes.
And be able to serve them better so that when the client has those life-defining moments, they're actually sticking with you instead of seeking advice somewhere else.
Yes, without a shadow of doubt. But I had to make the decision to split that model because I knew in my soul it wasn't the right model.
Yeah.
I needed to get out of that. And so then I started my journey of trying to figure out how to go more independent and to craft a better model. And I think that any advisors, and there's many great advisors in my world, and there's many great folks doing it in insurance. They're trying to figure this thing out. And I think if you can be the tip of the spear and be one of the first early adopters of that, you're going to have a better life. Like I was talking about wealth earlier.
Yeah.
Like money's not everything.
Right.
Like if I gave you all the money that you possibly could fathom and you could use that for 5 years, and then after 5 years, you're going to be poor. You're not going to have a lot of fun with that first 5 years, even though you're ridiculously wealthy.
You're
Why?
concerned about it?
Because you know that you're going to be poor later.
I don't know. I'd get my jet.
For 5 years.
Yeah.
Well, and then it goes away. But the whole idea is always that it's the perception of the wealth in general. And so I had to take some steps backwards in terms of financially, like, my income, knowing that I'm building towards something bigger and better.
Yeah. So I think that might...
And sustainable, quite frankly.
No.
Sustainable is huge.
Yeah, no.
Absolutely.
Go ahead. I mean, there's so many things around this that we could rabbit hole. I mean...
Well, I think there was one additional area that I was going to ask about. We've talked about it's better for a client, right? This type of model. Stickiness, we talked about, better retention over time.
Yes.
But and then we talked about, though, the amount of money you can make product selling, right? Which is a reality.
Totally.
But
hold your thought. Sorry. There was a firm that got busted and fined. I think it was last week, or at least it hit the news last week, where there was an insurance brokerage firm that was selling annuities and annuitizing the annuities, and then with the income off the annuities, buying and funding permanent life insurance.
Whoa.
And that firm got fined for a lot of money. So it was just kind of like, you can make a little bit more money if you're going to do.
Well, I mean, where I was going with that, I'm not sure that you can, though. I mean, I think where I was going with the rubber meets the road, right? Mm-hmm. I'm an advisor now. I believe in what you're saying. What has been your experience from a personal income perspective? Not to get into your personal situation, but I'm just saying, is there the revenue there to, when I work with my clients from the right perspective, to drive a similar or, better book of business that equates to my personal income?
Yeah, it'll be less.
And it's on your financial services side, but I think it equates to the, any of the other areas of our industry.
Yeah, I mean, I can't speak completely to the insurance side, right? I haven't been in that, so I don't want to overstep my bounds too much there. But
we don't. This is GPP.
It's GPP. Do whatever you want. For my situation, it became like you drop cuss words.
Hey.
All right. Sorry. Go ahead.
So the steps back are fine. So maybe some of the fatter bonuses aren't there, but then if he starts to become more consistency over time and you can plan on it, there's less things that come out of nowhere, right? You start building a more consistent income stream. And for us and clients and whatever, I think that's something we all kind of seek and we want. We want stability.
Yeah.
Right? And so when you're chasing big commissions, that's lumpy.
Yeah.
It really is. It's not
stressful.
It's stressful. It's lumpy. It's it's not a great way of going about it for the long haul for you. At least in my experience, that's how it was. You know, and I never felt like in the end I was being fulfilled on like, am I doing the right thing by these people? And that always carried so much weight that I could barely breathe.
Totally. Would you agree from your experience though that broader holistic model, does that bring, you're doing more for the client at that point? Is that, I mean,
you're doing more for the client. The client like cares about you so much more. You will receive equal revenue, but it's spread out further, right? You're spread out
not more
longer.
in some cases, because you're doing more, you're doing all of the planning for a client versus just doing this mutual fund.
Absolutely.
Be engaged in more areas potentially.
Yep.
And then, I can't help but to think about the referral game.
Absolutely.
When you're getting treated like that. So.
And the referral game is the most beautiful thing because you did a good job then. If you're not getting referral, I don't mean to be rude, but if you're not getting referrals, you're not doing your job right.
Absolutely.
100%.
I think that's a great point. Yeah. Well, I think, talking, this conversation is, do you have one more?
I've got one more, but when you're ready to wrap up, you let me know.
I'm just taking the cues from Big Al, so.
I know. I was going to ask Ben, so there's been a lot of stuff in the news lately about cryptocurrency, and you brought it up earlier. Just going to ask you, Mike.
Sorry about that.
Wow, this could be another 40
What
podcast.
is Dogecoin?
Does anybody actually know?
I think Elon actually answered that quite well in his 3 or 4 dodgy Saturday Night Live performances that he put out there. Whoa.
So, SNL skit.
Can we link the?
Can we link that YouTube in there? Yeah.
Okay, so I'm just curious though. No, I'm joking.
Yeah, you don't want me to really pull that on you, do you?
We're not recommending that for client portfolios. Disclaimer.
However, we will talk to you about it, and we will educate you on all of that. I mean, and at the end of the day, there's certain things that we don't necessarily deal with, but when it comes to our clients, if it's money and it touches them, whether it's real estate, whether it's whatever it is, if it doesn't have to go under our umbrella for us not to at least have an educated conversation about it. And then our clients ultimately are the ones. This is the last thing I'd like to end on is in our industry they always talk about fiduciaries and that we're supposed to be acting on the best interest of our clients. Frankly, clients need to become their own fiduciaries as well. They need to take a bit of ownership in terms of educating themselves and knowing the risks. So working with a good financial professional that's going to shoot you straight. It's not going to be a yes man.
Yep.
Those are the type of people you want to look for, quite frankly.
Oh, I think that's spot on. I mean, it's what an advisor is, right?
Yep.
To clients. So,
You betcha.
Well, thanks for coming on, man.
Thanks
That was
for
fun.
having me.
It's been great, Ben.
Yeah, it's good
We gotta
times,
do it
boys.
again.
Yeah, thank you very much.
It was a good time. So,
Thanks, Al.
yep, Big Al, good work. Next week, look forward to a great episode with Dan Allison. Pretty pumped.
Yep.
If you don't know him, check it out.
Check it out.
See ya.
To the moon.
To the moon.